Why is investor confidence in AI now wobbling?
In recent weeks, we've seen big companies announce that they're going to spend absolutely jaw-dropping amounts of money investing in AI. And whereas previously investors were cheering those announcements, actually lately we've seen the stock market wobble in response. It seems like they're getting a bit worried about whether they're going to get returns on all of this money that companies are spending on this new technology.
So what exactly is it that's making the stock markets jittery?
Well, it's not just that investors are worried about the amounts that companies are spending, although those amounts are vast. It's kind of this feeling that we've been here before. So there are lots of times throughout history where you've had a new technology emerge and it looks like it's going to transform the world. So take railways or canals or electricity or the internet. And in all of those cases, the new technology actually did transform the world. But in the early stages, when it was just coming out, investors got overexcited. They ended up bidding up companies' share prices out of all proportion with their underlying profits. And they also ended up picking the wrong firms, not buying the companies that would actually benefit from this. And then even when the new technology was really successful, a lot of investors lost an enormous amount of money. And there's kind of this worry that something similar is happening again, that AI might be this transformative technology, but share prices have been bid up out of all proportion with underlying profits.
So we're at a very nervous moment. What is it then that investors can do to avoid getting stuck?
This is something of a puzzle because you might think the obvious answer is, okay, shares are too pricey, so I'm going to sell my shares. Professional investors often don't have that as an option. For example, if I manage a stock fund and I tell clients invest in my fund and I'm going to invest in stocks, I can't just suddenly sell them and sit on a pile of cash. I might actually not be allowed to. Even if I am, my clients are going to ring me up and say, what are you doing? This isn't what I'm paying you for. Even for individual investors who can make the decision to sell their stocks, it's not necessarily a good idea. So take a previous boom, the dot-com boom, which ended in a crash. There were lots of wobbles on the way up, and at each wobble, nervous investors might have decided to sell their stocks. But actually, over the course of that boom, share prices rose by a factor of 12. So you would have really regretted selling your stocks on the way up. And in fact, even after share prices plunged, at the bottom of the crash, investors who had just held on through the ups and the downs would still have made money. Those who had sold out early wouldn't. So selling your stocks isn't necessarily the right thing to do, even if you think share prices are too expensive and you're worried about a crash.
So if selling up doesn't make sense, then what else can investors do?
Well, the classic way to hedge stock market risk is with bonds. Buy some bonds alongside your stocks. And the reason for this is that bond prices historically have tended to go up when stocks have gone down, so they've cushioned losses. Now, again, looking back at that previous boom, the dot-com one, investors who had hedged their stock market risk with bonds did very well throughout that period, because actually bond prices went up as stock prices went up, although not as much. And then when stock prices fell, bond prices rose. So they didn't hurt your profits too much on the way up, but they did compensate your losses on the way down. The trouble today is that we've seen this old relationship break down a bit recently. For example, when stock prices crashed in 2022, bond prices crashed along with them. And what was behind that was the worries were about inflation, and inflation can hurt the prices of both of these things. So if we got a similar crash today, and lots of investors are quite worried that inflation might cause a crash today, then bonds might not be as effective at protecting people's portfolios as they were in the past.
And what about an even older haven, gold?
Yeah, well, it's done very well recently. And as you say, this is a time-honoured hedge against chaos. What makes people worried about gold just now is counterintuitively just how well it's been doing recently. It's gone on a roaring bull run over the past year. At the start of this year, traders talk about prices going parabolic, just shooting up and seeming to go towards the moon. What can happen after that, though, is very large swings in prices. And we actually saw that a few weeks ago. The gold price dropped by about 9% in a single day and then swung wildly afterwards. When you see an asset that is supposed to be a hedge behaving like that, you might feel a little less confident that it's actually going to be a hedge. If it can swing so wildly, is it really a safe haven?
And are there any other alternatives then?
Again, counterintuitively, perhaps the best way to hedge stock market risk is with other stocks. So I looked at a study that analysts at Goldman Sachs did recently on hedges that would have performed particularly well during the dot-com bubble. And intriguingly, they found that some of the best ones were select baskets of stocks. So, for example, stocks that pay very high, reliable dividends. So they offer you a reliable income. They did well on the way up and the way down during the dot-com crash. Stocks with low volatilities, this is kind of dependable old companies. It might feel a little unsatisfying to say the best way to hedge your stock market risk is with other stocks. But when you look at the alternatives and how these have performed in the past, it might be the best that investors can do.
So it does sound like there's no way to bubble-proof your strategy.
Maybe no way to completely bubble-proof it, but there is a boring answer here, which is that the one safest investment strategy is buy and hold for the long term. Investors that rode out the dot-com bubble on the way up and on the way down and then held on for the following years, they still ended up doing very well. The very worst thing you can do is sell your stocks during the depths of a crash when you actually lose your money. The best advice anyone can give is invest slowly, steadily throughout your career while you're saving and just hold on through the ups and downs.
Josh, thank you very much.
Thanks for having me.